Hey everyone, my name is Brad. I've logged on to Investing Doc. Today I wanted to take a look at my cash on cash return for the real estate holding that I have for my medical office practice. I started my practice in 2018, and since then I bought into a new medical building as a condo owner. Oftentimes you'll hear that owning real estate for your practice can be one of the best investments any doctor will ever make. Let's take a look today at my cash on cash return to see how good of an investment this has been for me. Alright, the first thing is buying my medical office building as a condo unit. It's not its isolated set-alone building. The cost of the shell, which when you buy commercial real estate you often buy as a shell, was $1,050,000. The total condo build out was $450,000. The total money that I had to put down, about $375,000, which comes out to about 25% of the total cost. The first question I usually get is, why did I have to put down so much money? Well, I ended up doing my bank loan through Truist. They would have allowed me to do a 5% down, maybe even a 0% down for owner-occupied space, meaning I am basically leasing it to myself. I own all the entities. I own the practice and the building that we're renting out of. However, at this point in time, I only had 1 year of tax returns, not 2, and that is the problem that most banks had for me. Usually, most businesses file an extension for their tax returns, so you don't usually file your taxes on time. Most businesses file them later in the year. For example, this year I just filed my business taxes for 2022. And we're in July. You're almost always running about 1 year behind then on your taxes. So when I had only 1 year of taxes, that is when the bank basically said, we don't want to deal with you. For example, Wells Fargo, Bank of America, the large banks out there didn't even want to talk to me. I ended up going through Truist, which actually they were fantastic to work with, and they're not even sponsoring this post today. Back then, they would have allowed me to do a 5% down, maybe even a 0% down for owner occupied. Truist was telling me though that I could put maybe 5 to maybe 20% down depending on how things went by the time the construction was done, and they promised me they could definitely get it done. And they actually did get it done. I had to put 25% down because they approved me for a certain loan amount, and it went over that by about 5%. That was because I added things like in-house like Sonos speakers and things that I wanted to pay for, so I ended up paying that 5% extra just out of my pocket. But anyway, that's why I had to put 25% down. So if you have 2 years of tax returns, you may not have to put that much down for owner-occupied space. My cash on cash return. You have to pay yourself market rent. And in my area, market rent is about $11,500 a month for the space that I'm paying for myself. My vacancy rate is 0% since I've occupied the space from day one, and I plan to stay there indefinitely. My mortgage and other expenses, about $84,000 a year, excluding any fees. That gives me about $53,000 in income for the property. Let's talk about what the heck is cash on cash. Cash on cash return measures the amount of cash flow relative to the amount of cash invested in a property. Investment is calculated on a pre-tax basis. So for me, my cash on cash equals $53,000 divided by $375,000, which puts me at about a 14% cash on cash. That's pretty damn good. Anything above 10% for cash on cash return is considered really good. I really doubt I could have invested that money in the stock market and performed better on my own. But what if I would have invested in the market instead? I know that it's a short period of time, but from when I purchased the building until now, the S&P had a negative return of 5.8%. Meanwhile, my cash on cash return for the building, 14%. What if I would have put down 5% like they initially floated the idea if I had more than 2 years of tax returns? Man, that would have been amazing. If I would have put 5% down, that would have changed the equation for my cash on cash to be 71%. Most of the other docs in the building took advantage of this low 5% down from what I'm told. I don't think there's many other industries where as a physician you get the benefit of having banks willing to give you such a low amount down, and that allows you to have a potential massive cash on cash return. All right, so where does this go in the future for me? What do I plan on doing? Well, maybe down the future I'll plan on owning more spaces. However, right now I'm more into growth mode. And as we have tried to hire another physician and opening another location, as the previous video talked about, growing is actually taking a lot of effort. And I think while we still work out the kinks, we're planning on renting rather than buying right away. We can always do the buying later, take out loans, we can rent to ourselves and get that cash on cash return. But for right now, we're focused on expansion, and short-term, meaning 5 to 7 year lease terms for our rentals, is where we're at to optimize quick growth rather than trying to put a ton of money down, especially with the current uncertainty in the commercial real estate market. Hope you all enjoyed it. If you own your own practice and plan on being there for a long time, think about buying your own space. It may end up being one of the best investments you ever make. See y'all next time.